Have you ever wondered how to diversify your investments? Welcome to a world where financial decisions can make or break your portfolio. Today we delve into the realm of asset allocation, a powerful strategy that can help you manage risk and potentially boost your returns. By spreading your investments across different asset classes, you're not just putting all your eggs in one basket, but choosing the right baskets to put your eggs in. Stick around to gain a deeper understanding of how asset allocation works. To start, let's clarify what asset allocation means. Picture this, it's like organizing your wardrobe. You wouldn't want to fill it entirely with only shirts, would you? Similarly, asset allocation is the careful process of spreading your investments across various asset categories. It's about not being overly reliant on a single type of investment. You see, when you diversify your portfolio among different assets, let's say stocks, bonds, and cash, you're essentially creating a financial safety net. It's a strategy that aims to balance risk and reward according to your investment goals, risk tolerance, and investment horizon. Just as you would balance your wardrobe with a variety of shirts, trousers, and accessories, a well-balanced portfolio could include a mix of equities for growth, bonds for income, and cash for security. In other words, don't put all your eggs in one basket. Now, why should you care about asset allocation? Well, let's imagine you're on a voyage in the vast financial ocean. Your portfolio is the ship, and asset allocation is the compass guiding you towards your financial goals. Without this compass, you'd be sailing blind, exposed to the storms of market volatility and potential losses. One of the primary benefits of asset allocation is the diversification it provides. Think of it like not putting all your eggs in one basket. By spreading your investments across different asset classes, such as equities, bonds, real estate, and cash equivalents, you're less likely to suffer enormous losses if one sector performs poorly. It's a way of hedging your bets and ensuring that you're not overly dependent on the success of a single investment. Asset allocation also plays a significant role in risk management. Each asset class comes with its own level of risk and return potential. Equities, for instance, may offer high returns, but come with high risk. Bonds, on the other hand, offer lower returns, but are generally less risky. By allocating your assets wisely, you can balance this risk-reward trade-off according to your risk tolerance, investment horizon, and financial objectives. Moreover, asset allocation can potentially lead to higher returns. This is because different asset classes perform differently at different times. When one class is down, another might be up. Thus, a well-diversified portfolio can help smooth out returns over time. But perhaps the most compelling argument for asset allocation is that it can help you achieve your financial goals. Whether you're saving for retirement, a new home, or your child's education, a well-allocated portfolio can help you reach these milestones. It allows you to strategically plan your investments based on your specific targets and timeframes. So, whether you're a seasoned investor or just starting out, asset allocation is a vital part of your investment strategy. It's more than just a financial buzzword, it's a tool that, when used correctly, can navigate you through the tumultuous waters of the financial market and towards the shores of your financial goals. So, asset allocation can be your key to successful investing. How do you allocate assets effectively? Here are some steps to follow. Step 1. Determine your risk tolerance. This is crucial because it shapes the composition of your portfolio. Are you a risk taker, ready to weather the storm for potentially higher returns? Or are you more risk-averse, preferring a smooth ride with steady but possibly lower gains? Understanding your risk tolerance is about knowing how much market volatility you can stomach and how much loss you can endure while still sleeping soundly at night. Step 2. Set your financial goals. What do you want your money to do for you? Are you saving for a comfortable retirement, your children's college education, or perhaps a dream holiday? The time frame for your goals is important too. Short-term goals may require safer investments, while long-term goals may allow for more risk and potentially higher returns. Step 3. Select your asset classes. There are several asset classes to choose from, each with its own risk and return characteristics. Equities or stocks can offer high returns but come with higher risk. Bonds, on the other hand, are generally safer but offer lower returns. Cash and cash equivalents are the safest but also offer the lowest returns. Real estate and commodities, like gold and oil, can also be part of your portfolio. A good rule of thumb is to have a mix of different asset classes to spread the risk. Step 4. Decide on your asset allocation. This is where you decide what percentage of your portfolio goes into each asset class. A younger investor with a high risk tolerance and long-term financial goals might have a larger percentage in equities. An older investor nearing retirement with a lower risk tolerance might prefer a larger percentage in bonds or cash. Step 5. Implement your asset allocation strategy. Once you've decided on your asset allocation, it's time to put your money to work. You can do this by buying shares of stocks or bonds, investing in mutual funds or exchange-traded funds that track certain asset classes, or purchasing real estate. Step 6. Rebalance your portfolio regularly. Market fluctuations can throw your original asset allocation off balance. If equities perform well, they may end up taking a larger portion of your portfolio, thereby increasing your risk. To maintain your desired asset allocation, you need to rebalance your portfolio from time to time. This usually involves selling some of your well-performing assets and buying more of those that have underperformed. Remember, the key to successful asset allocation is balance and regular review. So don't just set it and forget it. Keep an eye on your portfolio, review it regularly, and make adjustments as needed. This way, you'll be well on your way to achieving your financial goals. While asset allocation is beneficial, some common mistakes can hinder its effectiveness. Let's delve into some of these common blunders. First and foremost is a lack of diversification. There's an old saying that goes, "Don't put all your eggs in one basket," and this holds true for asset allocation. When you concentrate your investments in one asset class, you are exposing yourself to unnecessary risk. If that particular asset class performs poorly, your entire portfolio suffers. Diversification, spreading your investments across various asset classes, can help mitigate this risk. Remember, the goal isn't to eliminate risk altogether, but to manage it in a way that aligns with your financial goals. Another common mistake is not rebalancing your portfolio. Asset allocation is not a set-it-and-forget-it strategy. Over time, market fluctuations can cause your asset allocation to drift from your original strategy. For instance, if equities have performed well, your portfolio may become too heavily weighted towards stocks. This could expose you to more risk than you initially intended. Regular rebalancing helps maintain your intended asset allocation and risk level. Reacting to market volatility is another pitfall to avoid. It's natural to feel anxious when the market is volatile, but making impulsive decisions based on short-term market movements can be detrimental to your long-term financial goals. Instead, stick to your investment plan and resist the urge to react to market noise. Finally, overlooking your time horizon and risk tolerance is a mistake many investors make. Your asset allocation strategy should reflect your financial goals, risk tolerance, and investment horizon. If you're investing for a long-term goal like retirement, you may be able to assume more risk and allocate more to equities. Conversely, if your goal is short-term, you may want to be more conservative and allocate more to bonds or cash. Avoiding these mistakes can enhance the effectiveness of your asset allocation strategy. Remember, asset allocation is a dynamic process. It requires regular review and adjustment. And while there's no one-size-fits-all approach, avoiding these common mistakes can help you stay on track to meet your financial goals. To wrap up, let's quickly recap what we've covered. We began by defining asset allocation, which is, at its core, the process of diversifying investments across different asset classes such as equities, bonds, and cash. The goal is to balance risk and reward according to your personal financial goals, risk tolerance, and investment horizon. We then delved into the importance of asset allocation. It's not just about potentially increasing your returns, but also about managing and mitigating risk. This is crucial because, as we all know, the world of investments can be unpredictable, and a well-diversified portfolio can help cushion the blow of market downturns. Next, we outlined the steps to effective asset allocation. These include determining your financial goals and risk tolerance, choosing the right mix of assets, and rebalancing your portfolio periodically to maintain your desired asset allocation. We also discussed common mistakes in asset allocation, such as not diversifying enough, being too conservative or aggressive and not adjusting your asset allocation as your circumstances change. In conclusion, asset allocation is not a one-size-fits-all strategy. It requires careful consideration of your unique financial situation and goals. It's not a set-and-forget strategy either. Regular review and adjustment are key to ensure it continues to serve your needs. Remember, asset allocation can be a powerful tool for managing risk and increasing returns. Make it a part of your investment strategy.